Welcome back, guys, to the Mortgage Reports. My name is Arjun Dhingra. I'm a contributor here. I've been in the industry for 25 years, and I love this platform because it helps consumers on every range, whether they are homeowners or they're people who want to become homeowners, including investors, on how to make smarter decisions when it comes to taking out mortgage debt and just understanding what's going on in our housing market. And today's topic is a popular one because it concerns HELOCs, which are really a trending topic. But the difference between a HELOC and a cash-out refinance and the real math that nobody talks about. So ordinarily, in our industry, most consumers, they're obsessed with interest rates, which means they're going to chase the lowest one, and they're going to make their decision based on that alone and choose to ignore everything else. Well, everything else is where the biggest mistake ultimately ends up being made. So first, what I want to do is give you a very simple and clean breakdown between a HELOC and a cash-out refinance, what they each mean, and when you would use either one. First, with a HELOC. Now, the reason why these are so popular is because many homeowners in the United States already have a very low interest rate on their first mortgage. So getting a HELOC allows you to keep that mortgage. You don't have to do anything to it. The HELOC just goes in right behind it, or what is referred to as second position. So it's adding a second mortgage to your line of debts. It's usually variable, and it gives you a lot of payment flexibility. And in most all cases, the payment is interest only. Now let's look at the other side with a cash out refinance. This is taking your existing mortgage, wiping it out, and constructing a new one. Now the difference between what you owe and what the new mortgage is for is the cash out or the cash back that you would get. Now this cash could be used for a number of things, which we'll get into here in just a second. But a cash out refinance, although it would likely have a higher interest rate, keeps things very simple because it also wipes out any high interest debt that you might have. So now let's look at an example. And most Americans will take a look and see what their interest rate is on their existing mortgage, and they think that that is the interest that they're carrying for their debt. When someone asks, what's the interest that you're paying on all the debt that you have, they'll think of their largest indebtedness, which is their mortgage, and they'll say that number. So let's take, for example, that you have a 4% interest rate on your current mortgage, but you're carrying some credit cards with balances that have interest rates of 24% attached to them. So to say that 4% is your rate is not actually correct. You have what is called a blended rate, which is taking the weighted average of all the debt you have and the interest that is attached to all those debts. So in this particular example of the 4% mortgage and the credit card debt that's over 24 or 25%, your blended rate is actually much higher. Now, in that simple example, if you were to take out a new mortgage, doing a cash out refinance at, let's just say 6.5%, even though this rate is higher, but because you wiped out all of that high interest debt, your monthly savings could end up being over $1,000. That's with the higher rate. So it's not about the rate, it's about managing the actual cash flow. Because if you've created a savings of $1,000 that can be kept back in your household, you can do a lot of powerful things with that money. That money could go towards things like finally starting that 529 plan for your kids. It could be just socked away into an emergency rainy day fund, which I think every household should have at least 6 months of expenses saved up in just a quick access liquid savings account or checking account that is only touched for emergency purposes. Imagine the peace of mind that that would give you. But again, $1,000 gives you a lot of options. One important one that I don't want to overlook is the ability to actually pay down your mortgage faster. If you were to actually apply that $1,000 back towards the principal balance, which, let's be honest, guys, you were already paying that money. It was just going to the credit cards or the high interest debt, which is doing you no good. You could accelerate the amount of amortization or paying down your mortgage debt over time. This shaves years off your mortgage, saves you tens or hundreds of thousands, in some cases, depending on what market you're in, millions of dollars in interest that you would pay. And now you're really increasing or accelerating your wealth position. So the point I'm making, guys, is taking out a higher interest rate when it's done for the right reasons could actually accelerate your wealth and put you ahead of the game. And so now you know how most people miscalculate what their true debt is and the cost of it. Okay, so let's talk about when it makes sense to take out a HELOC. When a HELOC is the winning strategy. When you want to preserve that low rate that you have on your first mortgage. Sometimes it's so low that it just doesn't make sense to give it up. And you want to make sure that you're working with a real certified mortgage advisor or a true mortgage professional to help you understand that distinction. When you just have a short-term need for capital. And lastly, when you just want quick and easy flexibility with accessing funds. For those reasons, a HELOC can make perfect sense. Now let's look at the other side. When does it make sense to do a cash out refinance? If you've got a lot of high interest debt and you need to consolidate it, this makes total sense. And just scroll back to the example that I gave you of someone who had the 4% interest on their mortgage, but was carrying high interest debt on top of that. If you're looking to reduce your payments, increase cash flow back into the household, and you just want simplicity of one payment, then a cash out refinance makes complete sense. So if you're trying to figure out what's the framework to help you decide, you can ask yourself these few questions. What actually reduces my monthly outflow? Would it be a HELOC or would it be a cash out refinance? And what, most importantly, improves my long-term payoff? What's either going to help me pay off my house faster, increase my equity position in this asset that I have, help me start that savings plan that I've been really neglecting, or help me create that emergency rainy day fund that I know I need to have, but I just just never have any dollars left over at the end of the month to actually make it happen. And above all, guys, the thing to take away here, if nothing else, is not to chase the rate. The rate is not the headline. Cash flow is the true story here and the thing that you must pay closest attention to. Now, this is a really hot topic again for most Americans because credit card debt is at an all-time high in the United States. Consumers are spending money faster than they can make it, and then waking up when they finally get the bill and realizing, I've got to do something about this. And that's the key. You must do something about it, because leaving revolving debt with interest rates that exceed 20 or even 25% and just making minimum payments on it is going to slowly make you broke. And I cannot stress that enough. So if you own a home, but you also have some debt, the home is your weapon. The home is your tool to getting out of that and actually putting yourself back onto a much better track. So don't sit still. Don't ignore or turn a blind eye to what's actually going on here, guys. Talk to a real, true mortgage professional, put together a game plan, and take control of your financial future. Thanks for listening, and we'll catch you guys on the next topic.